the risk of too many bulls in gold and silver, and OPEC oil capitulation. But first, let's look at the markets. The dollar is down 19. I'm sorry, up 19. Wishful thinking. 101.32. 10-year yields are 383, up 3. S&P 500 is 56.30, up 11. The VIX is 16.13, down 13. Gold is 25.02, down 9.70. That's on almost the lows of the session. Silver holding up, relatively speaking, at 29.52, down 7, almost 8 cents. Copper 4.16, down 4 cents, over almost 1%, give or take. Gold, silver holding its own, actually creeping lower despite metals being lower. WTI 73.51, up 32. Natural gas is 2.14, down 3, almost 4 cents.
The market update highlights the current state of various assets. The US dollar is up slightly, and the 10-year Treasury yield has risen. The S&P 500 has seen modest gains, while the VIX, a measure of market volatility, is slightly down. Gold has dropped significantly, nearing session lows, while silver is holding up better but still down slightly. Copper is down by about 1%. Oil prices are up, with WTI crude increasing slightly, while natural gas is down a bit. Bitcoin remains unchanged at $61,250. This snapshot indicates some bullish sentiment in precious metals and oil. Vince Lanci, a seasoned commodities trader and market strategist with deep expertise in precious metals and energy markets, highlights yesterday. The equities market saw a brief pullback but quickly regained momentum, with both the US and European markets posting gains. Overnight, equities generally held steady, except in China, where the market was weighed down by supply concerns in a quiet session. The S&P 500 is now just 0.5% below its all-time high, indicating resilience despite the pullback. Trading volumes were thin, typical during peak holiday season, with the S&P 500 down 20% and the European SXXP volume down 40% compared to their 20-day averages. During the summer holiday pullback between the 4th of July and Labor Day, market volumes typically lighten, and the path of least resistance appears bullish. Despite recent challenges like the BLS revisions, which were anticipated, the market has navigated them well. Strong consumer data, highlighted by Target's performance, added to the positive sentiment. Lanci briefly explains hedge funds are shifting their focus from large-cap to small-cap stocks, anticipating a potential Fed easing. This rotation suggests growing optimism in under-owned sectors, despite higher interest rates. Mutual funds are also reducing positions in mega-caps, which is bullish as long as no significant negative news emerges. Looking ahead, the market is focused on PMI data and Jerome Powell's upcoming speech. The FOMC minutes hinted at potential easing in September, with the market pricing in a 25 basis point cut. However, if Powell expresses concern about the labor market, a 50 basis point cut could be on the table. The wild card is whether Powell will signal that inflation targets are nearly met. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
Yesterday, after a brief pullback, the equities market regained momentum, with both the U.S. and Europe posting gains. The dollar dipped while U.S. curves steepened, which is bullish how it happened yesterday. Gold remained flat and oil continued to decline. Overnight, equities generally held a firmer footing last night, with the exception of China, where banks led, but the overall market appeared weighed down by supply in a quiet session. Quick comment on yesterday's behavior. Yesterday's market behavior was a reversion. It wasn't alarming, and the market's swift recovery later on yesterday confirmed this view. The S&P is now trading just 50 basis points below its all-time high. That's one of the reasons they tolerate high gold price. Volumes remained thin yesterday, with the S&P down 20% on volume, and the SXXP, that's a volume measure, down 40% compared to their 20-day averages, which is expected during peak holiday season. This is peak holiday season for the summer. Between 4th of July and Labor Day, you get the lull in volumes. In the lighter volume environment, right, the path of least resistance seems bullish right now, meaning the market will levitate with no news. There seems to be some captive buying in the stock market. So the market has also comfortably navigated this week's main catalyst unscathed. BLS revisions, which is the big deal yesterday. It's a big deal in how it was handled, the revisions themselves, but it was known it was coming for the most part. And we'll touch on that a little bit more later on. The true pace of that, however, as judged by Goldman Sachs economist, was better than expected. While consumer prints were better, highlighted by strong price action from Target on a beat and a raise. So that was this week's data thus far. The market, the stock market itself, under the surface, hedge fund flows are leaning towards broadening out exposure and reducing large caps in favor of small caps. So they're selling tech and they're buying smaller tech because they're all anticipating a Fed easing. This suggests that even in the absence of broad-based risk-taking, general sentiment has turned more positive regarding under-owned pockets of the market, many of which have been hampered by the recent higher rate environment. Mutual funds also cut positions in their mega caps. And it's bullish as long as there's no bearish news, meaning people are selling their big caps and they're buying smaller stocks. The question is, are they selling one share of an $1,000 stock and buying one share of a $1 stock, or are they selling one share of $1,000 stock and buying 1,000 shares of a $1 stock? That's really the question. So the bad news will make it worse for the stock market. It's that simple. We're in the middle of a rotation. And by the way, that's what Hartnett had said as well. So on deck for the rest of the week, PMIs will be watched closely today in both Europe and the US. But the main focus will remain on Powell's speech Friday. Right? The FOMC minutes yesterday hinted at easing policy in September, as the market has already priced that in. But any comments suggesting graver concerns regarding the labor market will likely push the market towards a 50 basis cut. So if Powell comes out saying, I'm worried about the labor market, then we're going to assume a 50 basis point cut. If Powell does not say that, then you assume a 25 basis point cut, if at all. I think the dark horse is that Powell's going to say we're close to our target in inflation, and we're going to let it float a little bit higher.
Citibank recently highlighted that commodity trading advisors, CTAs, are heavily long on both gold and silver, with gold's first sell level around 5% lower. Silver, however, is already near its sell level, which suggests CTAs might start selling soon. Despite this, there's unusual buying support for silver, indicating interest from the macro side. Historically, a small drop in gold prices can snowball, but recent trends show that CTAs are selling into strong buying, preventing deep declines. As the BRICS summit and elections approach, dips in these metals are likely to be shallow and could be buying opportunities. Regarding oil, Citibank noted that OPEC Plus might need to delay planned supply increases due to ongoing price weakness. If OPEC Plus decides to continue with the supply increase, the oil market could see further declines, although there's skepticism about OPEC Plus cutting back on production. Vince Lanci suggests the BLS has been revising job payrolls downward, with the latest revision showing an overestimation of 818,000 jobs over the past year, raising concerns about potential political bias. Let's now turn our attention to the video again.
Citibank made some comments about CTAs in all markets yesterday. No one else really is talking about this. But CTAs are max long both gold and silver, with the first sell level in gold minus 5% away at 24.35 and GCZ4. That's December futures contract. But in silver, the precious metal is trading right on top of its sell level this morning at 30.17. That's yesterday's comment. And that's, again, futures, December futures. So what they're saying is that CTAs are too long. It's a crowded trade, and they're probably going to start selling about $100 lower. Now, no, we'll talk about what I think in a second, right? But, in silver, they could start selling now, and they should start selling now, considering where copper is, right? Considering where gold is, but they're not. So that's a little bit weird, and it says to me that there's buying in silver coming out of the macro side. All right. So what does it mean, right? Forgiving my spelling. Historically, it means a $20 drop in gold snowballs into a $100 drop in the last 2 weeks. But lately, as demonstrated in price action in our own analysis, these CTA players, have been selling into buying underneath that is not letting the dips go deep or last long. We think that continues as the election and the BRICS summit approaches. So there will be dips. They should be bought. They won't be allowed to breathe too much. We have a full analysis on this, and we'll be posting it tomorrow. Topics in the upcoming report include CTA behavior, we refer to them as wildebeest, sell season, very significant between now and Halloween, technically between Labor Day and Halloween. But that's it's coming, and it's important, and it is the single largest reason to sell gold and silver, even if it's only for a 2-month period. It should mean the market goes lower. But we have a game plan to that effect. We have a commentary on oil as well, and we go into cities, gold, and silver analysis and results a little bit more. The next thing included at the bottom, we have a report from ING on oil weakness. Oil continues to come under pressure, and it is looking increasingly likely that OPEC Plus will have to delay its plans of gradually increasing supply. Otherwise, expect further price weakness. All right, OPEC needs to delay, all right, its increase in supply because the market is really getting ahead of itself. If OPEC delays its increase in supply, that will firm up the market as less supply will be coming on the market. I think there's a chance that they will do it anyway, and the oil market will continue to sell off. I guess putting it in trader terms is the oil market has sold off too much relative to this supply coming online. And to think, and I think the ING report is good, to think that OPEC will definitely cut back on pumping more. We're not going to put more on the market. I think might be an error. I think they're going to pump more. That's it. That continues at bottom. Market news. Yesterday's market news, I touched on this in the rundown. The BLS has been almost methodically, it's not random, has been over-reporting the job payrolls for the better part of a year, if not the whole year. Zero Hedge has been commenting on that, and they've been all over that early. And, that happens from time to time, but not every month. Every payroll is too high, is too high, is too high, is too high. And then they do another rebalancing, we'll call it annually. And that rebalancing, which the market anticipated, but still it was revised the whole year, it was revised down by an additional 818,000. If that's not bad enough and showing political bias at the BLS level.
The market is navigating through a period of mixed signals, with bullish momentum in certain areas like oil and small cap stocks, while potential risks loom in the overbought positions of gold, silver, and OPEC's oil strategy. Investors should stay vigilant as upcoming events, such as Powell's speech and global economic shifts, could significantly influence market direction. What is your opinion on the current scenario? We want to hear from you. Feel free to leave your thoughts in the comments, give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.